Welcome to the Rose Show podcast. Thank you so
Great.
much for joining us today. So excited to be here with someone who is so brilliant and also so cool. A fellow metalhead, Michael Cow. 30 years in money management. I love it. You're so cool. A commodities trader, Goldman Sachs portfolio manager, co-founder of Canyon Arbitrage Fund, a true entrepreneur and free thinker. You left and you founded and were CEO of Acanthos Capital Management, focused on opportunistic, value-driven investment strategies. And that's in ancient Greek cities as well. Now you run your own investment family office and you write an amazing Substack, Cowboy Musings. You've created a true intersection of finance, geopolitics, and thrash metal.
Right.
I love it. So how you doing?
Here we go.
Today?
Here, I got to show you.
Slayer.
I wore this just for you.
Thank you. Awesome.
Just for you.
So cool. And I have Iron Maiden. Very cool. So how you doing today, Mike?
Well, thanks for that kind intro and congratulations on your podcast. What a incredible success story so far. Amazing.
Thank you so much. Well, I have the same goals as you do with your amazing Substack. You know, we want to educate, want to encourage thinking. We want to elevate above the noise and entertain. So love your Substack, brilliant writing, and your thoughts on macro and geopolitics are like graduate level thinking. So
I appreciate that.
It's really awesome stuff. So, you know, we're going to be talking about markets, macro, money, and metal. So I guess we're bringing back the headbangers ball.
The four M's. I love it.
The four M's. I know that. We're going to go back to the 90s with the headbangers ball, and actually, right? And love actually back to the right. You remember that MTV and everything. You know, let's go back to the 90s and where it all began for you. How did you get started in the markets?
You know, it was serendipitous a little bit because I wanted to be a video game designer since I was in middle school. I was really, really good with computers, and I had self-taught like 4 programming languages by 9th grade, and that was my passion. I loved it. And I went to college for electrical engineering, computer science. But during that process, and I did a couple of engineering internships, I found that even though I liked the intellectual aspect and creative aspect of solving problems through writing programs, I didn't like the quality of work, like being sequestered in a cubicle and and just being like a lab rat like 24/7. And so I pivoted literally. It was around that time that I met my girlfriend, now wife. She was working for an investment bank at the time, and I remember I didn't know anything about Wall Street. I didn't know anything about business. She was the one that told me about what the Dow Jones Industrial Average was and what an IPO was. And I basically, like in my senior year, I pivoted and I decided to interview with these companies called Goldman Sachs and Morgan Stanley. I had no idea who they were. I had to ask some of my frat brothers who were business majors, are these good companies? Would this be like a good way to like learn about Wall Street? So I didn't even know that they had 2-year analyst programs. So I actually interviewed for an IT role, right? And I figured, okay, well, here's a way where I can, utilize what I know, which is coding, and then go to Wall Street at the same time. I wound up going to Goldman, and then in their IT group, and then I'm in this training program, and I'm learning all about markets, equities, forex, commodities, everything. And I realized almost immediately that you know what? If I wanted to be a programmer, I probably should have gone to like a company like Microsoft where programming was like the primary source of revenue. But if I'm going to be at Goldman here, rather than be a sort of back office support person, I'd much rather be in the front lines of business and be a revenue generator. So then I would spend pretty much like every lunch hour, going up surreptitiously to like human resources and the trading and asking them, how do I be a trader, things like that. And I remember getting sent on all these like wild goose chases. You got to read this book and this book and that book and that book. And, I kept educating myself about trading, about markets, about options. And I got drafted into this group. At the end of the training program, you take a proficiency test and you get drafted. You get drafted, the different divisions of the firm pick you, right? So I was lucky enough to get picked into what was the most profitable division of the firm back then, which was J. Aron, which was the currencies and commodities powerhouse that Goldman bought in the 80s. And I wound up for the first year working on programming the currency options systems for the sales traders there. And there was one fateful day where George Soros calls up the desk. Quantum Fund calls up. When Quantum Fund calls up, the whole trading desk goes silent, right? And he's asking for like a two-sided market on a $500 million Deutschmark currency options trade. He wants a two-sided market. And so the whole desk goes quiet, trying to figure out, is he a buyer? Is he a seller? How do we position for this? And I'm out on the desk debugging my new currency options program that just got rolled out, right? And, my client is the head sales guy who handled Soros. And I'm asking him, hey, tell me about this option trade. He sketches it out on a piece of paper, but he gets it all wrong. And I corrected him, right? 21-year-old me corrected the senior guy. And I didn't think anything of it. But then like 2 days later, I get a call from his boss's boss, my boss's boss's boss, who was Lloyd Blankfein's counterpart in sale. Lloyd ran trading, and his counterpart, a partner named Richard Whitten, ran sales. And Richard said, I hear you have a knack for options. Would you like to interview for an analyst role on the trading desk? And so literally within a year, so I wound up becoming an analyst on the commodity side. And then within a couple of months, I wound up becoming a trader. And then I traded for a couple of years there.
Wow.
So then I never looked back. That was the beginning of my finance career.
That's a fantastic story. Oh my gosh. Yeah. Amazing.
I don't think I've ever shared that with anybody in an interview, but yeah.
Wow. Thank you. I'm so honored that you did here. That's amazing. Well, you are so brilliant. You could tell through your writing, but that's so impressive. So from there, you went on to being a portfolio man. Well, you got your MBA at Wharton. Amazing. And then you went on to co-founding the Canyon Arbitrage Fund. And were you doing commodities there as well?
Yeah, no. So I'll tell you. So in my I did an interesting summer internship while I was in business school. I did a summer internship for the Harvard Endowment Company, Harvard Management Company. And that was a very impactful internship for me because I was exposed to so many different types of relative value strategies like equity long short, convertible arbitrage, merger arbitrage, commodity index. Well, commodity index arbitrage is what I was already doing at Goldman, so I already knew about that. But it just blew my mind that, holy shit, when I came out of Goldman, I already knew that I wanted a job on the buy side because I just thought that, boy, it's interesting to be a market maker, but at the end of the day, your profitability as a trader was only as good as the franchise of the firm, right? So you don't like if you're a market maker for like a small bucket shop of a firm, you don't get the flows like a Goldman Sachs J. Aron would get, right? So there's inherent value, franchise value to the seat that you're in. But what I loved about the buy side is that it doesn't, you could be like a relatively smaller hedge fund, but if you had good ideas, it's a true meritocracy, right? I mean, if you had good ideas, you eat what you kill. And so that, but to me, the idea of a hedge fund was macro primarily, right? And trend followers, because that's all I was exposed to at J. Aron. This Harvard management internship exposed me to this just much bigger world of different types of ways of alternative asset management. And back then, hedge funds weren't a thing. Hedge funds didn't recruit at Wharton. I think out of a class of 800 MBA students, I think I might have been the only person that was looking at hedge funds back then. And I think there were only two hedge funds that recruited on campus back then. It was Citadel, which was just starting out. They had 500 million under management, and then there was a firm called HBK that had they were also around that size. And I just remember reaching out to probably 200 different I got my hands on this interesting directory of hedge funds, and I reached out to everybody, and I wound up finding I wound up getting job offers from both HBK and Citadel and this other startup hedge fund called Rose Glen in Philly, but I wanted to be in LA. And I wound up getting a job offer from a place called Canyon, which was started by these really smart credit investors that came out of Drexel. And by the way, the LA hedge fund community tends to be very credit driven, primarily because of the Drexel diaspora, right? So when Drexel went under in the early 90s, there are so many successful ex-Drexelites that started firms like Oaktree, right? Ares, Apollo, right? These are all ex-Drexel folks. So I went to Canyon. Canyon was primarily a credit-driven shop that was more or less focused on high yield and direct lending and bank loans at the time. It was interesting because for the first year, I joined Canyon in '97. This was the eve of the Asian contagion, right? When there was a huge wave of currency devaluations in Southeast Asia. And so for the first year, I didn't know credit analysis, but I knew options and hedging. So I was asked to really help hedge their existing positions in a number of emerging market trades, oil and gas, an oil and gas equity portfolio that I was trying to figure out ways of hedging it because the oil market collapsed in 1998. The coal credit contagion. So during that process, I did a lot of portfolio hedging, but then I also started looking at an asset class that I thought was very orphaned at the time, which was convertibles, specifically busted convertibles. And busted convertibles, for your viewers that don't know, it's actually a technical term. It means that convertibles that are way out of the money with respect to their strike, and so are typically it's a very inefficiently priced asset class because it's in that no man's land where the equity sensitive convertible players wind up selling it because this convert is now becoming too bond like. But because convertible securities tend to be unsecured debt, they typically rank below senior regular high yield debt, right? And they have lower coupons.
Yes.
So these busted converts wind up trading down sometimes into like the 30s and 40s, right? So there were times where I basically started a business within a business at Canyon, and I wrote a white paper back then to the partners in the wake of 1998. I said, look, I wrote a white paper called Alpha with Asymmetry, and my vision. Oh, before I tell you about the white paper, in the wake of 1998, when LTCM blew up, there also were incredible opportunities in risk arbitrage and merger arbitrage, right? Because LTCM they were supposed to be doing fixed income arb, but they had levered risk arb positions that blew out, and so there were these massive spreads in merger deals. So my nascent book that I was managing at Canyon had a combination of option strategies, hedged convertible trades, and merger arbs. So I decided to write a business plan that I thought tie everything together thematically. It was called Alpha with Asymmetry. And my observation was this: convertible and options arb, they tend to be positive gamma type strategies, right? Merger arb, if you think about it, is kind of like being short optionality, right? Because you typically have a 95% likelihood of making the deal spread or the deal goes through, but in that 5% chance where the deal busts, you lose your ass. That's very, very similar to being short optionality or short gamma. But my idea was that if you could have a diversified portfolio where you had very smart position picking, security selection at the idiosyncratic level, you can make a really interesting business out of it. So the partners there, Josh Friedman and Mitch Julis, let me have the ball and run with it. And I wound up building it into a very successful and profitable business there. And that the Canyon Capital Arbitrage Fund was an offshoot of their main business in which I was a partner. And then when I left in 2002 to start Acanthos Capital, it was with the idea that, hey, I've always wanted to try it on my own as well. I left on very good terms. I'm still very good friends with Josh and Mitch to this day. So I started and I ran my firm ultimately for 17 years. And by the way, Acanthos, while I know that you researched Acanthos as a Greek city, that's actually not why I named it Acanthos. Acanthos is actually the Greek term for acanthus, which is the leafy ornamentation at the top of a Corinthian capital. And my logo was a Corinthian capital. And I loved art history also. I know we share that in common. I love Greek mythology, Greek art history.
Art history as well.
So my official story for Acanthos Capital was it's the leafy ornamentation at the top of a Corinthian capital. The unofficial story is that it got me at the top of the alphabet and it sounded better than aardvark. So
I love that. Great story. You're a great storyteller as well. Wow. I mean, very impressive pedigree you have with the merger arbitrage and your specialization across all asset classes. And I love the acanthus leaf at the top of the Corinthian. There's the Ionic, the Doral, and then I love the acanthus leaf. That's so cool. I didn't know that. Thank you for telling us. That's how you had the name. I don't know where to begin. There's so many questions I have regarding your whole background. It's just amazing. I'm sure a lot of these terms, because many listeners won't understand, that's fine. I find them very complex myself. Busted convertibles, very impressive, great way with that. Now, when you went into your Acanthos, did you still continue with the arbitrage and any convertibles, or were you focused more on commodities, or was it just everything?
Yeah, so let me tell you. So I like to think of my career as almost like bookended by commodities, but like the meat of my career was actually not in commodities at all, right? Because during my years at Canyon, with the exception of hedging an existing oil service portfolio in 1998, from the period of, call it 1999, all the way through 2015-ish, I really didn't do much in commodities because my bread was primarily buttered by finding interesting, what I would call capital structure setups. So most people on Twitter, let me just get something right out there. So most people on Twitter know me as like a macro commentator. But there's two reasons for that. One is that I still have my investment advisor open, and so I never talk about idiosyncratic positions. I don't play hard and fast with the regulatory rules. I know tons of people do that, and I don't. So I never talk idiosyncratic positions. So I comment on macro. Macro has also become very, very important in recent years because of what's happened with oil and inflation and whatnot. But my entire career, all of the money I've ever made has been on essentially idiosyncratic setups, idiosyncratic risk, and that's still true for today. So in the early years of Acanthos, I would say that I had a very distinctive story, a sort of a differentiated story. I was known to be a very creative problem solver. I remember how I described, computer science as creative problem solving. That's how I viewed finance. So I'll give you an example. The best way to do this is illustrate by example. Yeah. So back in, I want to say maybe 2005, there was a oil pipeline company called El Paso, right? They were very levered, and they had a 1-year convertible that was about to expire, and it was trading, call it at 90 cents on the dollar. They had a 10% yield to put. My analyst, analyzed it. There was all the senior secured debt above it, and he just proposed it as just an outright long, right, to just capture that 10 points to the put date. And we discussed it, and looking at the capital structure, I noticed that, okay, well, there's a senior secured revolver above that convert that was yielding maybe, call it 8 or 9%. There was also a pari passu long duration piece of debt that was trading in the 70s that matured, had a much later maturity date. And so it occurred to me that, what if I did this trade? What if I shorted that convert at 90 cents on the dollar, went long that long duration paper at 78 cents on the dollar, and then at the same time went long the senior secured revolver? Now, why would I do this? It sounds very complicated. What I created was effectively a synthetic event option. Okay, so here's my thinking. If El Paso is very levered, if they went bankrupt, right, the convertible, the short-term convert that was being artificially held up at 90 cents on the dollar would converge to that long-dated convert, that long-dated long bond at 78 cents on the dollar. You see, because in bankruptcy, duration mismatches don't matter. They all equilibrate, right? So I make money in a bankruptcy. And by the way, in a bankruptcy, I'm still long that senior secured piece of paper at 8%. That's rock solid. I'm going to clip that coupon no matter what. But there were rumors that Chevron Texaco might buy this company. If they bought this company for stock, presumably, right, it would be an incredible home run, because the convert that I was short was puttable and callable at par, meaning that it could only go up to par. I would only lose about 10 points on my short. But the senior bonds at 78, right, would all of a sudden become single A credit, which meant that under Chevron Texaco, if they bought them, those bonds at 78 would go up to about 120. It'd make almost 50 points on my long bond. And senior secured still clips that 8%. So I had a portfolio that had all these different types of setups like this. And I always told my clients that, you know what, it's impossible to predict when some of these event options happen, but when they do happen, they're very, very asymmetric, and there's almost no downside. There's almost no possible way for me to lose money on these trades.
That's
right. Now the thing is, after the financial crisis, things changed, because the financial crisis made it so that these types of setups were very, very difficult to do, because the prime brokers need to extend you margin terms for you to have these setups. So we basically had to adapt, and run like a lower levered book, and we became what I would call value investors, but across the capital structure. So one of my favorite investment books of all time is Margin of Safety by Seth Klarman. I actually have one of the real books. Those books go for like $2,000 now or something like that. But anyways, what I like about that book above most value investing books is it looks across the capital structure, which was exactly the way we viewed it. We didn't just look at cheap equities. We looked at the Fulcrum security. The Fulcrum security is that part of the capital structure that where even a small change in the enterprise value can result in a massive change of value for the Fulcrum security. So let me just explain for a second. If you have a very levered company, you might have a situation where the total enterprise value is high, but the equity value is small because most of the value of the enterprise is in the debt, right? Well, in that case, the Fulcrum security is the equity, right? It's right. But in certain extreme cases of leveraged companies, the equity is worthless. The Fulcrum might be a busted convert. And so probably one of the best years that I've ever had in my career was in 2009, in the aftermath of 2008, where there were all these busted converts that traded down to essentially 4 to 5 cents on the dollar.
Wow.
I was buying General Growth Properties convertible bonds at 4 cents on the dollar. I was buying General Motors senior unsecured convertible bonds at like between 4 to 6 cents on the dollar. And these things wound up becoming massive home runs because we bet on the Fulcrum security, and ultimately upon the restructuring, they became huge. And so that brings me, this long story, but it brings me to the world of commodities, right? So around the 2015 era or so, I had an equity position that was a commodity based, an oil producer, get smacked really hard when the oil bear market started at the end of 2014. And that's when I said, hey, you know what? I started my career in macro. I still have all my macro contacts. I need to re-put back on my macro hat and really, really focus on the macro again so I don't get blindsided. Because my career had been focused on mainly micro analysis, but I really got blindsided on macro in 2015. And I had to really refocus. And so, that position that I talk about that I still manage now is actually the result. It's another one of these Fulcrum securities, right? So what happened was in 2016, there were a whole ton of bankruptcies in the oil and gas space. And one of the companies that I followed was an upstream MLP that went bankrupt. They had way too much leverage. This company had a panoply of assets that consisted of conventional production, but they also bought this amazing piece of contiguous acreage in the Permian Basin, but they paid top dollar for it. They paid like peak pricing for it. So my firm owns senior unsecured bonds, as did a number of other hedge funds. And long story short, this was a very contentious, long drawn out restructuring that took like 28 months. So we spent huge legal fees in this situation, but we ultimately we split the company up, gave the conventional assets over to the second lien holders, but we unsecured bondholders were the fulcrum of that capital structure. We injected new capital and bought out the Permian assets of the company, and we started a brand new company. It's a post-reorg equity, right? Post-reorganization equity is where, I think of it as a phoenix rising from the ashes of the old corpus, right? So in a bankruptcy, old debt gets wiped out, and whatever is the fulcrum security usually winds up having the biggest upside. And so when I decided to shut my fund down and essentially retire from active hedge fund management, I retained one position basically in this post-reorg equity, which is a private equity that I still oversee on behalf of myself and clients. And so that's the reason why I pay very, very close attention to the oil space.
Mm-hmm. Yes. Wow. Put commodities aside, I find the idiosyncratic positions absolutely fascinating. The capital structures, that's a discussion I'd love to have more of. There's just so much. I have to say, Mike, this is amazing stuff, what you've done. And it's so fascinating, merger arbitrage to, finding opportunities. You're just a opportunistic, very creative investor. It's very creative. It's all about problem solving, and you're finding these creative solutions, and you reduce risk. There's like you said, there's like no downside. You've covered every side of it, and it's just amazing. The restructuring, the reallocation, like a new company's formed, like the rising from the ashes. Okay, let's take the concept of idiosyncratic positions. What do you see in the current 2023 market space with all the moving parts that we have going on right now that keep moving? What are you seeing in this landscape?
Yeah, so without naming specific names, because I told you why I don't do that, but I can give you some interesting themes.
Yeah, themes.
So I've been saying for the last several weeks since, or I guess for the last month now, it's been a month since Silicon Valley Bank basically blew up, and the aftermath of that is that I was very early on in saying that I really don't think that the current crisis or the next crisis is going to be a banking crisis. There's always a tendency for people to fight the last war.
Yes.
And when people were making some comparisons to like another GFC, I'm like, no, this is not going to be GFC 2.0. Not even close. Not even close. Because I lived through GFC 1.0, and this was a period where you had in basically 1 month you had Fannie and Freddie get seized. You had Lehman fail. You had WAMU get seized. You had Wachovia near the brink. You had Morgan Stanley and Goldman within basically having like 1 week of liquidity left. No, this is nothing compared to GFC. Nothing. And so I said that early on. I said, this BTFP facility is going to be a successful ring fencing of the banking contagion, but don't conflate it. Do not conflate it with the Fed giving up its inflation fight, right? And so I still believe that to be true, but I've been totally wrong on the market's reaction here, because the market, it's crazy to think that what the market has done in the face of the Silicon Valley Bank collapse, because the market has essentially, I think, conflated this issue with a flooding of liquidity in the system, which it is not. It's not the same. This type of the balance sheet, yes, has expanded, but it's a very different. It's not stimulative in the way QE is stimulative.
Absolutely.
This is expensive capital meant to bridge a gap. But I very much believe that we are in the throes of a structural stagflation.
Exactly.
Okay.
Agree.
And so from a macro perspective, I keep throwing away money on puts. I have currency hedges on and I have puts on, right? But on the idiosyncratic side of the portfolio, by the way, I'm always net long risk. I'm never net short risk, contrary to what most people might think, because a lot of time, because when I opine on macro, I'm usually talking about how I'm hedging my book. On the but on the idiosyncratic side of my portfolio, I've noticed that again, with this tendency of people fighting the last war, there have been positions in non-bank financials that have totally collapsed based upon people thinking that, I mean, there's all this FUD on Twitter that's just totally misinformed FUD, talking about how there are certain companies that have these held to maturity losses that swamp their equity cushions, blah, blah, blah. But there are certain non-bank financials where there's no forcing function for that asset liability mismatch to get crystallized. You see what I'm saying? So the banking sector is extraordinarily fragile to contagion, primarily because the liability side of the balance sheet is basically short-term deposits, right? And so with Silicon Valley Bank, right, you had a situation where you had it was almost unique in terms of poor management on both the asset and on the liability side of the management. They did not hedge any of their duration risk on the left side of the balance sheet, and they had way too concentrated deposit base that made it very, very subject to bank runs. But when the Twitter sphere starts conflating that and ascribing the same dynamics to companies like certain brokerage companies, certain insurance companies, where there's no forcing function, well, to me, that's really interesting. So I'm giving you a little bit of a hint on where I'm finding interesting about idiosyncratic value.
Absolutely, we appreciate the hints. Thank you so much for explaining that backdrop. I'm in the same camp as you, stagflation. I've been saying that since last year, and that's, there's so many directions we can go with this. The everything bubble, everyone's talking about that bursting at this point. The next crisis, I agree with you, it's not 2008 repeat, it never is. This is a different time. This is liquidity issues, not credit. They didn't hedge their duration risk. They had too many concentration of deposits, all that. Agree with you. It's not going to be repeated so easily. Like everyone tries to simplify everything, like to put everything in a little box. But the world isn't like that. And so what are your thoughts on the OPEC and cutting back production? What does that say to you now that you've had time to digest all that and everything that's transpired since? What are your thoughts in that space and what's going on?
So I've written extensively about oil over the last couple of years. It's very, very I thought the bullish signal was extremely clear at the beginning of 21. If you go back to some of the threads that I've written, I think I outlined multiple reasons for whether they're geopolitical, but also like just the coming out of COVID, the tightness of the market, all that stuff, right? Starting in probably the summer, actually in April of 22, I wound up turning cautious a little bit prematurely because I missed the very peak of it. But it turned out to be mostly right, that to be cautious and even bearish, right? Because my point was that this Fed tightening, right, is going to reduce demand. I think everybody was too myopic in focusing on, there's no evidence of demand destruction in oil, blah, blah, blah. I'm like, okay, my counter to that was that the Fed's mission and global central bank's mission is to create demand destruction, not just for oil, but for everything.
Exactly.
Okay. So it doesn't necessarily take $150 or $200 oil to create demand destruction for oil when you've got a reduction, a concerted global attempt to reduce aggregate demand for goods and services across the board, right? And okay, so now with this OPEC plus decision, you're going to like this. I call it the geopolitical mosh pit, right? I wrote a thread last October. I talked about how, in a world where you've got inflation that's higher than what we've seen in decades,
Yes.
it creates an every man for himself dynamic amongst the world's central banks. OPEC plus is the world's central bank for oil.
Mm-hmm.
All the other central banks are central banks for their respective currencies. But to me, OPEC plus first showed its cards when I wrote that geopolitical mosh pit thread back in October. They had already talked about a sort of symbolic cut. Now, this time, this was a surprise cut, and it surprised me, honestly. And I think that what they've effectively done is they've shifted. So demand destruction was starting to happen. You could see it. You could just see it, because I also wrote a thread about the great Chinese reopening or not, right?
Mm-hmm.
And my friend Alex Dahel has also been very vocal about this, that this China reopening is likely to be a dud, and that has certainly been the case.
Mm-hmm.
And demand is slowing down. Now, what OPEC did was they shifted the supply curve up and to the left. But I literally tweeted about this today. I think there is a cost in doing so, because we are now that much further along the curve in global tightening, and you're starting to see finally some softness in the unemployment numbers,
Mm-hmm.
right? I think it doesn't take $100 oil anymore to create more demand destruction as say $150 oil did
Mm-hmm.
a year ago. You follow what I'm saying? The
Yes.
transmission mechanism for demand destruction is a lower threshold for oil now, because of
Yes.
this variable lag of global monetary tightening.
Yes.
Okay, so I think OPEC is playing somewhat of a short-sighted game. I'm surprised that they did this cut as early as they did.
Mm-hmm.
I thought that they might have waited until maybe oil even had a 50 handle, right? But to me, they kind of jumped the gun, and all the everybody's rejoicing about it. And look, I'm massively long oil risk through my private equity, right? And so I'm happy about it in the short term. But what gives me pause is what the what the longer term ramifications are. And I've been saying that I think that by shifting the supply curve up and to the left at a
Mm-hmm.
time when this transmission mechanism for demand destruction is more efficient right now, it's going to result in a more elastic demand curve, right? Because of
Mm-hmm.
that transmission mechanism. But it's also clearly resulting in a more elastic future supply curve, because think about it, spare capacity. I was on the more conservative end of spare capacity, because I tend to believe one of my favorite oil analysts is Lakshmi Srikumar, whom I cite a lot. She's a private desk analyst at Capital One, and prior to all of these OPEC cuts, she was probably on one of the most most conservative in assuming that global spare capacity was in the 3 to 4 million barrel per day range, when a lot of the bullish consensus said that it was in the 0 to 2 million barrel per, right? So now I'm guessing that bullish consensus is saying that, with all these spare capacity cuts, they think spare capacity is in the 2 to 3 range. Lashmi thinks the true spare capacity is now up to 6 million barrels per day. That's a big number. That means that the forward-looking supply curve, not to be confused with the forward curve, okay?
Mm-hmm.
Totally different concepts. The supply curve conceptually has to be more elastic going forward,
Mm-hmm.
right? And then the other reason why it's also more elastic is that who's been stockpiling our SPR barrels? China. Okay, so if there were some kind of sort of geopolitical emergency that does spike the price of oil, I don't necessarily think we see, because of this increased elasticity, I don't necessarily think we see like a flyaway oil price, because between a much higher OPEC plus spare capacity number and the fact that China has stockpiled a ton of cheap oil over the last year, that increased supply elasticity will probably keep oil from really spiking. So, it's so I think it's, OPEC has gone for short-term gain, but perhaps at the expense of longer-term gain.
Got it.
They've eliminated short-term pain, perhaps at the expense of long-term gain.
Yes, and that's what it seems to be the theme overall. We, like when the Fed gave us all the free money, making rates negative, there's so many long-term consequences from that massive QE. Then we have mass government spending still going on. We talk about the demand destruction across the whole board, for everything, that even a small difference in the oil price, like you said, the threshold has come down. You don't need $150 oil for there to be such a massive impact. Now it's just a small difference because prices are elevated across the board. And, the unemployment, even though it came in at 3.5, we know that layoffs are incoming, and it's just a matter of time. As sales come down, businesses are going to have to reduce their costs. Margins are compressed. There's further deterioration in earnings, and we know how the cycles work. So it's just a matter, it's going to take time. Stagflation seems very likely, and I think we haven't faced this in a very long time. And there's a recency bias. And like you talk about, people think they're still talking about a Fed pivot. They think that the banking system is going to be a contagion, and there's going to be
100%,
right? And where do you think, if you had to hypothesize or think of, where do you think things can break next?
Well, so I do think I've been writing about this, how I think that the risk is probably not in the banking sector, but more so in the shadow banking sector. And the shadow banking sector obviously is a much more loosely defined term, but it can basically be any kind of financial intermediary, right? From a hedge fund manager to a VC fund to an endowment fund to a private equity fund. And so I've given this example. I mean, look, as a hedge fund manager, I've been on the brunt of asset liability mismatches myself, right? So in 2006, there was a firm called Amaranth Capital that blew up, and one of my largest LPs, which was a $5 billion fund of funds, was invested in that hedge fund. Well, as part of the reason, because of the black eye they got for that blow up, they got a bunch of redemptions from their LPs, right? Whom they had promised 30-day liquidity, unbeknownst to me, right? They were invested in managers like me that had quarterly and annual liquidity, right? So they had their version of a run on the bank where they could not satisfy their redemption requests, and they had to effectively gate and put their entire fund of funds into liquidation. Well, that then impacted managers like me, right? So that's what made my life in 07 and 08 extremely stressful and challenging, because I was dealing with how to return the LP money of this giant LP that had to fire all of their managers because of this asset liability mismatch that they created by themselves. Now, when you think about that, you think about the potential for what this very steep Fed hiking can do. It can certainly create that in the hedge fund space. But now there are interconnected funds that for that invest both in public and private securities. There are venture capital funds that now, in the aftermath of Silicon Valley Bank collapsing, and also just this net liquidity drain out of banks in general in favor of, say, T-bills, right? It's basically going to create it's going to create capital starvation across the board. And so one other form of slow motion train wreck that I can see happening, slower motion asset liability mismatch, is what happens when venture capital funds need to support their ailing portfolio companies, right? They're going to start picking up the pace of capital calls, right? And who are their LPs? Their LPs are going to be people, high net worth individuals, institutions, endowments, whatever. But more likely than not, especially in the endowment space, there could be hidden icebergs there too, right? Where they need to write big checks at a time where they're getting kicked in the teeth on who knows what else is in their portfolio, commercial real estate, right? So these are, it's very, very hard to pinpoint, and it's very, very hard to figure out. I mean, I'll tell you about one other idiosyncratic theme that I haven't. It's more of a short theme, but I haven't really explored it as a short theme. It's more what types of things I'm avoiding idiosyncratically. It's the idea that we talked about risk arbitrage, right? We talked about event-driven positions, and that El Paso trade example, I gave you an example of how you have a short-term bond that's basically being artificially held up at 90 cents on the dollar because of the impending maturity, right? So I like to think of that construct because, look, if there are securities out there that are being held up artificially by an impending maturity or by an artificially high yield, okay, while the underlying credit fundamentals are deteriorating, that's a danger sign. So I'll give you an example. I follow this yieldy closed-end fund that specializes in CLOs, collateralized loan obligations, CLO equity specifically, right? So look, the underlying collateral of CLOs are leveraged bank loans, which are safe assets. But once you apply a lot of leverage to it, right, it can be dangerous if even the default rate starts picking up a little bit. It'll propagate throughout the capital structure, right? And so there's this equity that I look at that the yield is just incredibly juicy, like 15-16% yield. And so during the tumult inspired by Silicon Valley Bank, that security took a tumble, and I bought some. But then when I started doing a little bit more work on it, I realized, wait a second, their distribution coverage ratio has deteriorated massively in the last 2 quarters. Went from fully covering their distributions 2x to below 1.0, right? And this is before defaults even spike, right? The second thing is, it was despite the fact that it's yielding 15 or 16%, it was trading something like 12% above NAV. So that 16% yield, believe it or not, represented an artificially elevated price. So I took a quick gain on it and I punted it, because there's a saying that I used to tell my analysts: the road to financial ruin is often paved with excessively positive carry. And so that is something that, while I don't necessarily want to short things that are yielding 15-16%. These are very expensive shorts. That guiding principle is certainly telling me what things to maybe avoid. on the idiosyncratic front.
Very
If I
well
was
said.
if I was managing my fund, I would probably be much more amenable to doing these types of short positions. But nowadays I don't really want to complicate my life too much.
Absolutely. Sometimes the best investment is no investment, and
That's
just
right,
to
especially
avoid. It's not necessarily a short.
100%,
Exactly.
100%.
So, wow, fascinating stuff. I have to say this discussion I'm thinking of Socrates, and I'm thinking the more I learn, the more I realize I know nothing, because you are enlightening me to so many things. I've been in private equity myself and businesses and a lot of mergers and acquisitions, but this is a whole new level. Your experience is amazing. Thank you so much for all this. I think what we can do is right now, liquidity is the big issue.
Yeah,
Liquidity. And we're in this liquidity
100%.
matrix. And right?
That's what I like to call it. Yeah,
Yeah, exactly.
I call it the liquidity lottery matrix. And the market is still, as you said earlier, it's still in this belief that
4,100 SPX, right? Is it right there?
yeah. So
Crazy.
do I wish that I didn't keep wasting premium on this stuff? Yeah, but on the other hand, it's I don't really understand this. I posted this interesting tweet today about the yield curve, because the tweet basically showed how in the wake of Silicon Valley Bank, right, yields collapsed across the board. Basically, the yield curve was expecting like an imminent pivot, right? So it just tells you that like people tend to ascribe this sort of omniscience to the bond market and to the yield curve. But when you look at how much the yield curve itself whips around, it tells you, and how much Fed fund expectations themselves whip around. I call it, if you think of the Fed funds rate as basically the primary Jenga block upon which all things financial are based upon, right? Because the Fed funds rate is, for all intents and purposes, the risk-free rate that determines discount rates for everything under the sun, from private equity to commercial real estate to equities, everything, right? If the underlying Jenga block at the bottom of the tower is oscillating so much like this, right? Can you imagine trying to make sense of the oscillations at the top of the tower? So to me, when I look at these gyrations in risk assets like equities, for instance, right, or Bitcoin, to me, I call that like the tip of the whip, right? It's sort of like that risk-free rate. I not to mix metaphors, but if you think of that risk-free rate as your whip handle, right? That and if that handle itself is like gyrating like crazy, imagine the tip of the whip. And so what we're seeing in risk assets is that tip of the whip, and it's I personally think we haven't seen the worst of it right now. The market is proving me wrong, but look, I'm like I said, I'm always net long idiosyncratic risk, but I have macro overlays on them. So
absolutely. Well, risk-free rates greater than the SPX and NASDAQ earnings yield. To me, I look at the market, I just see expensive and fundamentally doesn't make sense. We have an earnings recession upon us, deteriorating earnings. I think it's only getting worse. Having been in the business world 25 years, I see my margins are getting compressed. They have been. We have new fees, higher cost of goods services, cost of goods sold, and operating expenses. It just doesn't end, and I think it's almost like in a fantasy land right now. So let's talk about diversification across asset classes. CLOs, you mentioned those, CMOs, there's fixed income, commodities, gold. Now Bitcoin is showing that it has maybe a storage of value. It's inelastic supply, real estate. What are your thoughts across all asset classes?
So one of the things that I tried to do personally after, because I've been in money management all my life, I've never outsourced any of the management of my personal balance sheet to anybody, except for I started doing that in the last couple of years because I decided that I wanted to find orthogonal vectors. I'm appealing to your inner mathematician now, right? I'm trying to find orthogonal vectors to my own skill set when I allocate money. So over the last several years, I've been allocating to funds where the underlying asset class and the underlying manager skill set is totally orthogonal to my own, right? So I don't have any money in passively managed equity. I don't have any sort of passive beta in my portfolio. So for me, it's my own personal balance sheet is I have a lot of real estate. I have a lot of oil and gas exposure. I've been building liquidity in T-bills as a separate liquidity cushion. But then I have an alternatives portfolio. I've over the last several years, I've probably invested in like maybe 12 different funds and privates, ranging in character from funds that play in the RMBS space, funds that play in sort of opportunistic direct lending via structured equity or structured debt lending. I've invested in interesting what I call multi-sleeve funds that have different themes. One theme might be rural car washes. One theme might be sort of real economy private equity. That they're buying real businesses at 4 to 5 times EBITDA in sort of boring but real economy types of businesses. I have a little bit in venture capital and startups, not that much. So these are all my own attempts at diversifying exposure and having exposure to different ways of thinking.
Absolutely. I agree. I'm actually very similar mindset. I think diversification is key. And I like with businesses and acquisitions, I do like inelastic sectors that are resilient to recessions, necessary things, like you said, rural car washes. I like that idea. Automation is key. We have a reduction in productivity across the board, but I think this is all part of the cycles that we go in, and this is how you birth new industries, and there's new emerging businesses, right? And we're in a new era and a new regime. So we need to think different. And that's actually the theme of my website, but it's always think differently about things and just remain open-minded, flexible. And I also like the T-bills. I've been doing ladders with them. So I remain liquid. And, the rate is just great. I think it's the highest it's been since 2007. So to me, equities, I'm an options trader, so I can go in, I do some spreads and stuff. But, I just think that passive investing, like you said, is just very risky. And we don't know, there's so much volatility. We don't know where we're going to be in 6 months. So it's very difficult to just throw your money somewhere and, just expect, alpha. Equities, are you, when you say you have that oil and energy investment, are you long energy? Are you in crude? Are you in any of the refineries, the drill, the services?
No,
Any of those?
No,
No.
so because I have such a concentrated position in this post-reorg private equity, and just so you know, so this private equity, what it represents is a self-liquidating play on a finite asset, right? So we have incredible acreage. We're producing a lot of oil, but unlike a public equity, which essentially has to redeploy that cash flow into the ground, net of whatever distributions they make to investors, there is still a certain amount of capital reallocation risk that you as the end investor holding a public equity has, right? It's that capital reallocation risk has lessened since the days of 2014, 2015, but I can tell you that having lived through those days, you had egregious examples of capital misallocation because the management teams of the oil companies back then were very much incentivized by growing production as opposed to capital return, right? So you had this, that's why you had this complete shit show between 2014 and 2018, where, just as a lot of long cycle projects were coming online, the shale guys were just drill, 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 and they didn't really care about profitability because their incentive programs weren't based upon that, right? So there was no discipline, and the capital reallocation was terrible. So so when I'll give you an example. So so we were involved in this one company that we were involved in the bonds. This company was about to, they literally were in technical default on their bonds. They stopped paying coupons on their bonds. But I think 2 weeks before they did that, they spent like $100 million on basically untested acreage in a completely different geographic area to their primary asset, right? And so that almost borders on what creditors call fraudulent conveyance, where you're basically moving, you're almost like asset stripping. You're almost like, you've paid out cash should be going to the senior creditors first and foremost, not punting on a piece of untested acreage, right? So anyways, when we formed this new company out of the carcass of that 2016 bankruptcy I told you about, this is unrelated to that other company. We decided that the new business plan we would not have any capital reallocation risk, and so all production profits would basically be distributed back to shareholders. So it's a great position to be in. It's a great position to be in because it's spinning off a lot of cash flow.
Cash flow
for me now, but it took a while, but that's why I don't. So because of that, I've stayed disciplined and I don't play in other oil equities. I don't need to. I have more than enough exposure. If anything, from time to time, I might do some hedges. There was a period in time back, I think it might have been early 22 or late 21, where our Department of Energy was spouting off all this nonsense about threatening, crude export bans and things like that. And so I put on, at the time, I had a interesting trade on where I was long XOP puts and simultaneously long Brent futures, because the idea was that if they did such a ban, right, even if it was temporary, it would absolutely crush the shale sector equities, right? But at the same time, if you know about our refining network, our refiners are tooled for heavier grades, right? And so even as WTI and domestic producers would collapse in such a situation, Brent would be actually spiking and gasoline prices would actually spike at that time. So every once in a while, I'll do like a little sort of structured trade like that. That particular trade, I called it my administration stupidity trade. or administration stupidity hedge. You know, but yeah, so sometimes it's been a while. Sometimes I'll Texas hedge where I might be so bulled up where I might actually even be long oil futures. But you know, I haven't been. The flip side is that, you know, I'm in constant communication with my management team, and I was just discussing this with a friend. My oil private equity position is so large that I would never personally put on a huge short position, because the difficulty of that, right, is that I've got this oil equity where the underlying hedging is out of my control. If I wind up putting on like a big short in futures, right, there's no offset, there's no immediate offset against it. And so if I'm wrong about, let's say, a surprise OPEC plus hike, you get blown out of the water, right? So I try to not get too cute on stuff like that. Yeah. I ultimately, the reason why I've outsourced now management of some of my finances to outside managers, and in this case to this management team, is I trust the management team that they have a skill set that's orthogonal to my own, and you know, I gotta trust them ultimately.
Yes, you need to, and you know, it's risk management's number one, and that's exactly how you get your creative investments. So I know we're wrapping up now. We're at our time. I just want to end with one last question. What are your thoughts? I want to get into metal too, but I really want to know. I really want to know your thoughts on the future. What you, with all your vast experience and what you've seen for the past 30 years, even though in the short term the market isn't reacting the way you thought it would, we want to take a bird's eye view. And usually long term, it tends to make more sense. So what are you thinking into 2024 and 2025?
Look, I think, yeah, that's further out than I tend to think.
Or like 2023 then, just in the future.
No, that's, I take that back, because I guess I always think like so part of the reason why I also started outsourcing to external managers is that I do want to have more of a multi-year view, right? Because in my 25 years of fund management, right, the thing that drove me crazy about that business is you're only as good as your last month. You literally have to reinvent yourself every freaking month and every quarter and every year, right? And so that short-termism eventually kind of burned me out. And so I do want to be more cognizant of taking longer term views like that. And so when I've done my asset allocation, I've taken that part into account. For this decade, I am concerned that this is a different, we're in a different structure, economic structure, than we've been in decades. Yes. And recency bias is something I've talked about a lot in all my tweets over the last 2 years.
Exactly.
Because I think that we haven't seen a structural stagflation like this in many, many decades. If you look at, I was in a Twitter Spaces, you know, a couple, maybe a month or two ago, and I think it was Cameron Dawson who posted this great graphic that I retweeted a couple of times. It basically showed core PCE going all the way back to the 90s, right? And you basically see this tight band between, like, you know, call it 0 and 2.5%, right? And then now it's like boom, 5%.
I think I saw that.
It's so out of whack compared to the last several decades. And so now let's think about what we've seen in those decades. We saw the tequila crisis in 1994. We saw the Asian contagion in 1998. We saw the internet bubble burst in 2000, 2001. We saw the GFC in 08. And then obviously COVID. In every single one of those crises, the Fed was able to come in and save the day by just flooding the system with money, monetary stimulus, with no repercussions because there was no structural inflation. So at the risk of saying this time it's different, I do think this time is different.
Yes.
And so that's what worries me, because I'm a child of the 70s. I was too young to be an investor in the 70s, right? But I've studied it a lot, and I'm always worried about my own blind spots. And I'm willing to miss the FOMO of this runaway, ridiculous bull market, because I tweeted this out last week. I said, the reason why I'm not one of these FOMO traders that worries about the momentum is that I feel, and I keep my macro hedges on, is that I think that if I wind up being right, the result is going to be just asymmetrically bad on the downside for a lot of risk assets. And I'm constantly worried about what the next shoe to fall is. And it's interesting. The market rally is totally fading as we speak.
Yeah, makes sense. We have persistently elevated inflation. Exactly.
Yeah, I think that is a game changer. And then to kind of wrap up our conversation, is that, going back to oil, right? To me, oil is what started this inflation conflagration, which is what I called it, right? Because in 2021, I wrote as early as 2021 that oil was the link to. That's when I first started using the term U.S. dollar wrecking ball. I wrote a thread in 2021, I think, talking about how oil inflation, because oil is such a primary factor of production in everything, it would seep into other areas of the market. And because of that, it would create a Fed that was hawkish before the rest of the world, which in turn would cause a strong dollar, a US dollar wrecking ball, which ultimately has some negative feedback loops. But now what complicates everything is that, today we saw a CPI, and the market initially rallied on this because the headline CPI dropped a lot, but the core CPI remained very strong. 5. And by the way, the reason why the headline CPI dropped was because oil dropped so much.
Exactly. I tweeted that.
What's obviously not captured in that, what OPEC Plus just did.
Yes.
So to me, this has the potential to kind of like reset the clock to like 2021. Look, risk asset prices are not as dear as they were in 2021. But I think that when you look at the price action of gold and Bitcoin, and even this like flocking back into like the FANG stocks, they're all pricing in a world that I'm not seeing right now. And I don't see how the Fed can basically pivot aggressively, especially when they did ring fence this contagion situation.
Exactly right. Well said.
So we'll see what happens.
Exactly. And just to end on a metal note, because we want to talk about metal. Yeah. So give us your favorite bands.
Oh my gosh. Well, this is definitely one of them. I'm very sad to say that I think they retired back in 2019, and I'm proud to say that I saw their very last 2 shows at the LA Forum, and yes, I did go into the pit. So Slayer is one of my favorite live bands to watch because just the intensity. There's nothing like a Slayer pit. I'm a you know uh, aspiring guitar player. Also, I've been playing for I don't know 15 years or so. My favorite band to play on guitar is Metallica. Yeah, I think Kirk is an incredible, and James. They're all incredible musicians, but I, I I like the structure of Metallica songs. If you actually play and then play guitar, you will realize that their songs are structured so mathematically. Um, there's a certain mathematical beauty to their songs.
Beautiful.
They're
Yeah.
oh yeah, they're like just like the number of times that certain riffs are played. They're like usually in multiples of like 8. And it's very very interesting. Like
Beautiful.
I never realized how much like playing guitar would make me appreciate music that much more, but it has, because once you start studying the structure, the song structure, and what they're doing with the chords and everything, it's really really interesting. So Metallica and Slayer are definitely my 2 favorite bands after all these years. And it's funny because in high school I had that proverbial denim jacket, and my 2 big patches were Metallica and Slayer.
So cool. Wow. Not much has changed since, but
But Iron Maiden, Judas Priest, all that old
Judas
school
Priest is
metal.
great.
Judas Priest is what got me into metal. So
Wow.
love them.
Awesome. Thank you so much for everything. Structure. I love that word. That's like the word of the day. Structure. Capital structures to musical structures.
Bringing order to chaos.
I love it. There's an amazing book based on entropy. It is Randall Schweller, I think his name is. He wrote the what is the book? Oh yeah, Maxwell's Demon and the Golden Apple. Did you ever read that book?
Have not read that.
Okay.
Although I did a deep dive on quantum. I love reading about that stuff too.
Okay. It's an amazing book. It's basically about global discord in the new millennium. And it's about how multitasking, being distracted, disorganized lives in this fragmented world we're in. And he uses the apple of discord, the golden apple discord, the start of the Trojan War. And that's the name of the book. And he talks about how entropy is occurring and how disorder reigns supreme in our new regime that we're in. Just check it out. It's a really cool book. I read it years ago, and I'm going to read it again.
I like that.
Yeah, it's all about discord and everything. Thank you so much. You're so brilliant.
Thank you for having me.
Thank you for enlightening us all. This is like beyond graduate level. I mean, this is like PhD level capital structures and idiosyncratic positioning and money. So we talked about markets, macro, money, and metal. Thank you, Mike.
We did it. Thanks, Ro.